Hello and welcome to the Killik & Co market update. This week we've had some great results from Nike, which has provided a great example of a company that has actually benefited from the pandemic. For the quarter from June till August this year, Nike reported an increase in digital sales of 82%. Now, increasing its proportion of digital sales has been a key part of Nike's strategy, and its previous aim was to get to a point where 30% of total sales took place digitally. However, this week, Nike has announced that it has hit that target already 3 years ahead of schedule, and that's all thanks to the fact that the coronavirus has forced more people to shop online. Now, clearly the pandemic has been bad news for some companies, but for others like Nike that have a lot of automation in their production lines, a good online presence, and also a good distribution network, the pandemic has actually provided an opportunity to thrive and also to take market share. In contrast to Nike, a company that has definitely not benefited from the pandemic is HSBC, and it's worth noting that the shares have recently hit a 25-year low. Here's a chart showing the share price going back to 1985, and as you can see, the share price is currently back to where it was in 1995. The shares have been hit by an increase in regulation following the financial crisis, numerous fines for misconduct, the US-China trade war, the protests in Hong Kong, low interest rates, and most recently, the coronavirus. Banks have certainly set aside huge amounts of money to cover potential losses relating to this pandemic, but with much of the world heading back into lockdown, it's very difficult to know how high these losses could get. And finally this week, many UK savers will be disappointed by the drastic reduction in interest rates at NS&I, or National Savings and Investments. Here's a summary of the changes. As you can see, the interest on the direct saver account is being cut from 1% to just 0.15%, and many other key interest rates are being reduced to just 0.01%. NS&I is effectively a state-owned savings bank. Its deposits are protected by the government, but they're also used to finance government activities. And if you bear in mind that at the moment the yield on a 1-year UK government bond is just 0.04%, it doesn't really make sense for the government to be paying 1% interest on NS&I deposits. Here's the statement that was published by NS&I when they announced these interest rate reductions. Given successive reductions in the Bank of England base rate in March and subsequent reductions in interest rates by other providers, several of our products have become best buy, and we have experienced extremely high demand as a consequence. It is important that we strike a balance between the interests of savers, taxpayers, and the broader financial services sector, and it is time for NS&I to return to a more normal competitive position for our products. So I think it's really interesting here that NS&I is clearly bearing in mind the state of UK retail banks at the moment. It's difficult enough for these banks as it is without NS&I trying to entice away their customers with higher interest rates. So it really does seem as though the key reason for this interest rate reduction is to level the playing field across the financial sector. Moving on to have a look at next week, we've got results coming out from Ferguson and also from PepsiCo. That's it from us. Have a great weekend, and we'll see you next Friday.